Howdy there, folks. Welcome into tonight's video. So, got an interesting one here. Got a couple to react to. Both Josh Brown videos. So it's a Josh Brown dedicated video, I guess. Okay. So one is this one. This is from actually yesterday afternoon. He says we could be lining up for face ripper rally. So I want to hear what he has to say around a face ripper rally, and then we're going to react to this one here, which is 26%. 26% of stocks are in an uptrend. I want to hear where he's going with that and what his kind of thought process is there, because I think that's interesting. Let's just put it that way. So first off, thank you everybody for joining me. As always, we are over 12,000 subscribers, approaching 13,000 now on this channel, which is ridiculous. We got an outdoor video. It's beautiful. It might be, I don't know, 74 degrees outside right now, 75 degrees. You can't beat it, okay? It's nice weather in Vegas finally. If you're looking to join my private stock group and get access to everything in there, check out the pinned comment down there to get access to the Discord chats, to get access to our weekly investor report, all the Discord chats with the fellow shareholders of Palantir, Tesla, and all the others, and also access to the course curriculum. And if you're looking for to join us in there, check out pinned comment. Let's jump into this. Thanks for everybody that subscribe to the channel, as always.
Into and out of this week's Fed meeting. Was today the start of that? Sounds crazy given how negative everyone seems to be these days. Well, one well-known CNBC contributor says it could in fact be the case, and the signal could be in the bond market. He is Josh Brown. He is the co-founder of Ritholtz Wealth Management, and he is on the phone. Josh, thank you so much for calling in. It was at about 2:25 or so where you sent me an email that sent the following: blow off top for short-term yield, treasury yields, the 2-year failing at 4%, VIX barely budging higher, 10-year calling BS on the 2-year. It's saying, quote unquote, the Fed ain't getting to 425 this year. This smells like a rip your face off rally brewing into after the FOMC. Wow. What led you to believe that this was about to happen?
First off, if before we get into this, if this happens, I will say, great call by him, because not a lot of people are predicting that right now. And one thing I've noticed in the market is we get way oversold at particular moments. And to give you an example of that, the NASDAQ, for instance, is down almost 13% since August 15th. So a little over a month ago. That's an extraordinary new move. And think about it. Apple's held up really well in that amount of time. If it wasn't, I mean, if Apple just had been doing bad like everything else has been doing bad, NASDAQ right now would be down about 15 or 16% in a little over 1 month's time. That's an extraordinary move there, okay? So let's get into this.
Super, thanks for having me. I was just watching the VIX fail to confirm. Like, if we were going to have rates continue to shoot straight up, that should have been accompanied by a lot more stock market volatility than what we were seeing. Like, that pair has been working all year as being coincident with each other, and the VIX just couldn't get excited today. Then you see the 2-year yield kind of flirting with 396, 397, not really pushing through. Had all the reason in the world to push through, and it didn't happen. And the 10-year gets stopped at about 3.5, which doesn't mean it's going to get stopped there forever, but 3.5 is highly significant on the 10-year Treasury. That was the high back in 2018 when the bond market basically told Trump his trade war wasn't working. That was an important level when the Fed pivoted in the fall of 2018, and that was where the 10-year Treasury got to this June, which is when the market hit its low. So these levels are really, like, you don't have to believe in them, but enough other people do that they're important to watch. So when the VIX failed to really get going today, and you started seeing, like, the large cap tech names bottoming out, etc., you just look at this setup. This guy's going to come in on Wednesday, tell you what you already know he's going to say. Everyone is expecting hawkishness. Everyone is expecting 75 or 100 basis points. Yardeni's saying 100 basis points. If he delivers that, the narrative is going to change to, okay, great. So another 25 in November, another 25 in December, we're probably good. Once that narrative is seized upon, people are not long enough, and I think you could have a face ripper.
The other point.
Wow. Big prediction there. In terms of the 2-year, as of yesterday, that was trading at the highest level we've seen it since like 2007. The 10-year yesterday was trading at the highest level we've seen since 2011. So, you're talking extraordinary moves that we haven't seen in 10, 15 years in countless of these, different instruments out there in the financial markets. It's just what we're seeing. So this is a big prediction here. Because, if it doesn't come true now, everybody's going to be looking at Josh Brown saying, wait, you told us a face ripper rally was coming here, mister, and we don't have it.
I guess this makes the point that maybe the Fed can't be as aggressive as it sounds as though it will be, or some expect it to be, and that's why the bond market is reacting in some respects to what you just said, and then the stock market follows in turn. And by the way, I was waiting for us to settle out to see if we could actually close at 3,900 on the S&P. We're at 3,899.99. I saw just for a moment there, we did make it to 39, and we're still settling out. So we're like right at a technical level that a lot are watching. But in some respects, is that what this is about? That the Fed is just not going to be able to be as aggressive as Jay Powell certainly sounds like he will be.
Look, I don't even think the first set of rate hikes have actually worked their way through the economy yet, but the early indications are that demand is crashing. You look at home builder sentiment, you look at existing home sales, you look at anything to do with housing. It's like heading into almost free fall at this point in time. And part of it is seasonal, I understand, but that's a really, really big and important chunk of the market. You listen to what semiconductor companies are telling you about double ordering and gluts. You look at shipping costs are falling through the floor. You look at gasoline, like all of the things that.
And by the way, a lot of that is very, very good news for a lot of companies that have had their margins completely destroyed because of expenses rising, whether it's transportation and you had to ship something overseas, or whether we're talking about trucking something, everything across the board has just been out of control, and it's hurt a lot of companies' profit margins in a considerable way. But those things are rolling off now, and in 2023, a lot of these companies that were working with these massive headwinds, it's going to get a lot better for them in relation to that.
Screaming bloody murder about, and rightfully so, in January, February, March, April, they are now directionally doing exactly what the Fed needs them to do. Whether or not the Fed did it is not the point, right? The point is where they're going. So I don't know. Look, the market doesn't believe that the Fed is getting to 4.25. That might be what their dot plot says on Wednesday, at the conclusion of this meeting. The market just doesn't believe it. Doesn't believe they'll need to, or doesn't believe they can get there without already causing a recession, which would cause rates to start falling. So that inversion, it should be on everyone's screen. That is the thing right now. So I'm not telling you the economy is bad. I'm not saying any of that. I'm saying right now the setup is that it would be very hard for the Fed to shock us to the downside.
Got you.
True.
I appreciate you calling in. I know you're jammed up, and I so much appreciate that. We can continue the conversation on the halftime report tomorrow.
Yeah, okay, so we'll get into this video in just a second, but something I think is important is, Wall Street loves to definitely play their games, right? They sell stocks heavy, which, by the way, why is the NASDAQ down 13% roughly in the past a little over 1 month? Why is that? Well, because Wall Street decided to put massive selling pressure on the market. It's for no other reason than that. No other reason. Wall Street decided to, put massive selling pressure on the market for the past little, month and a week. And so they want to put massive selling pressure. There's not going to be enough buying pressure on the other side. Boom, you get the market down 13%. The NASDAQ, that is, right? S&P 500 is down 10.5% roughly in the past 1 month and in 1 week. So, for them to all of a sudden buy and cause a face ripper rally, it wouldn't be out of the stretch of imagination. All they got to do is put some money up, get the buying pressure going. You obviously already flushed out a ton of selling over the past, a little over 1 month. So what he's saying there is not a real possibility. I'm not going to obviously place a bet either way on whatever's happening there. But would I be surprised if we had a massive rally after the meeting? No, I wouldn't. That'd be Wall Street being Wall Street. All right, guys, let's jump into this one. This is interesting. 26% of stocks are in an uptrend. Where is he going with this one? This is from a few hours ago.
Like an earnings warning to get in the way of your bullish call for stocks. Is that the culprit? Just take us through that for those who didn't hear it. You told me yesterday about 2:30 in the afternoon, market set up for a rip your face off rally both into and out of the Fed meeting. Market actually took off into the close yesterday, but here we are after Ford. Is that the culprit?
No, nobody cares about Ford. Listen, here's what I want you to pay attention to. By the way, I think we're in a bear market still, no matter what happens. until that changes technically. That's just where I am. But I think that we're set up for a face-ripping rally here, more so than we're set up for more of what we're seeing today.
Okay, so he's doubling down on this today. That's interesting. Okay, so doubling down on the face-ripper rally. He's really in the belief camp that we're about to have a face-ripper rally here. Alrighty.
And here's where my conviction comes from. The VIX just can't get excited. You have the 2-year has done the Fed's job for it. It's there. It's at 4%. It was at 397 yesterday, 4% today. Like, that's the thing. That's what it had to do. That's where it is. That's what financial conditions now are based on. We're there. We did that work. It took all year. It was torture. It was very painful for a lot of sectors of the market, but we've done that. Take a look at what's happening with the internals today versus the last time we had this spike in yields and a rough stock market. Today looks nothing like mid-June. Right now, you're looking at 13% of S&P 500 stocks at a 52-week low. In mid-June, it was 40%. This is a very different situation. Look at a percentage of stocks above the 200-day, meaning stocks in a defined uptrend. 26% are in an uptrend. If you go back to June 16th, it was 13%. Almost nothing in an uptrend. This is a very different tape. Puts a call ratio now 54% versus about 86% then. The fear, the volatility is just not there. Nothing like the last time we were at these levels, which leads me to believe, as hawkish as we think the Fed will be, and they should, that's their job right now, I just don't think the market has enough fear in it. And I just don't think we're going to get the same kind of reaction we got last time. And stocks are sniffing that out right now, and that's where I believe we're set up.
Okay, so we'll jump back into that in just a moment. But, you know, if we take a moment and think about, you know, previous crashes and those sorts of things, right? Ex-Rona. I don't want to talk about the Rona crash because that was kind of a freak event. It was, you know, super drastic down, super drastic back up on the other side. I really, you know, in order to find the last real crash, you know, that was lasting and lasted a long time, took us, you know, 18 to 20 months to roughly get through that, right? We have to go back to the 2008 crash there, okay? And I mean, if we go back in time, what you're going to find is we double bottomed, and this chart might not show it because this isn't a detailed enough chart, unfortunately. I'm showing you guys here. But basically what happened in that whole situation was we double bottomed. We had bottomed basically for the NASDAQ, the true bottom of the NASDAQ. This chart's, you know, unfortunately it takes it by a 1 month increments. This is not accurate. So it's showing here like the bottom you would think is in February of 2009, but it wasn't. There was a second time the NASDAQ bottom. The true time the NASDAQ bottom was around October, November of 2008, actually, the NASDAQ really bottomed. Then it double bottomed in basically around that February, March time. And so, you know, think about that for a moment. We could be in a situation where we get back down close to that. Now, the S&P 500, for instance, did actually hit a new bottom in early 2009. So there's just something to kind of keep in mind there. Sometimes the different indexes can act differently, right? Not everything's going to be exactly the same. The S&P 500 can sell off differently than the Russell can sell off, which can sell off differently than the NASDAQ. You know, they're all made up of different stocks for the most part, other than, you know, like Apple can be in like the Dow, and it can be in obviously the NASDAQ as well, and the Qs and things like that, and the S&P 500. But that's just kind of something to kind of think about there when he brings up that point, okay?
You want to opine on that? Because I would love your take as well.
Well, okay, so the rates have been rising all year, and yet the S&P 500 is down 19%. Mm-hmm. So it is a struggle for equities when bond yields go higher, and bond yields are going higher. I know we're all focused on tomorrow. Do they go 75? Do they go 100? It doesn't matter. Rates are going higher. Are
bond yields going higher than where they are now? I think is a critical question. Or to Josh's point, it's kind of maybe this is where they top out. Fed can continue to.
So why that's an important subject? Because I don't talk a lot about bonds. Obviously, on the channel, I hardly ever talk about bonds. I'm very stock focused. But the reason they're bringing up that, and the reason that's important, is investors can look out there and they can say, okay, you know, why would I buy stocks right now when I can get, you know, 4% on a bond or 5% on a bond or something like that, right? Or 3.9% over here in a T-bill. So that's the way some investors look at it. It's gotten more competitive for stock allocation. I guess that's the best way I could put it. It's gotten more competitive. And so now people are looking, investors could be looking like, do I really want to buy stocks, or maybe I just want to buy bonds? And it depends on the investor. If you're a growth investor, you 4% on a bond or 5% on a bond, or heck, even 6% if you got that on a bond, which is kind of unrealistic. You don't care about that. It's a joke to you. You're trying to double, triple, quadruple up your money over the next 5 years. Bonds are not appealing to you, but there's a huge segment of investors out there that if you can also attract them with a 4% yield on something, they're like, okay, that sounds interesting to me, right? The interesting part is also a lot of stock prices have come down. So stocks that do pay dividends, the yield has gone up a lot on those stocks, right? And as long as they keep their dividends the same in terms of the amount of money they pay out, the yield you're getting on that is pretty darn high yield. There's a lot of big dividend payers now. So the nice thing about a stock market crash is, in a financial market crash, is it makes things a lot cheaper. And the yields you can get from many things, whether it's a dividend stock or it's a bond, is much higher than you'd get in a normalized environment. That's just bottom line there, right? And obviously the price you can pay for a stock is, significantly depressed compared to what it would usually be. Look at Shopify. At the beginning of this year, you had to pay, a massive amount for Shopify. Now, you buy Shopify, you get to pay 77% less than what you would have had to 9 months ago. Think about that. 77% less for the same share that you could have bought at the beginning of this year. So that's an interesting part where, everybody talks about how bad it is, but they don't realize, the opportunities that are presented to yourself is just ridiculous.
But they do, but does that necessarily mean that rates continue to go up?
I think rates have to go a lot higher. Inflation is not an easy fix. And we know we have not only inflation here, but globally. Did you see Germany's inflation numbers yesterday? You saw Sweden raised rates by 100 basis points because they're behind the curve. So for years and years, we had central bankers that were easy across every country, right? Now it's quite the opposite. And that is a big, big tailwind for equities, for risk assets. I kind of agree with Cooperman today.
I think she meant headwind. Tailwind would be it's helping assets, but yeah.
Headwind.
Excuse me, headwind.
Oh, yeah, that it is.
Headwind, right. But I kind of agree with Cooperman, what he said today. So the market is kind of struggling. It's a challenge. I agree with that. But there are stocks to be found, right? I have a whole list to buy, right? And that I have been adding to on the weakness because I am a long-term investor. I'm not making money in these things right now.
It's harder to find those names. I mean, in fairness, it's not easy to go out and find a lot of names that are so super attractive today. I mean, he also painted a picture of which the market is.
Did he just say it's not easy, or it is easy to find a bunch of stocks that are attractive?
Find a lot of names that are so super attractive today. I mean, in fairness, it's not easy to go out and find a lot of names that are so super attractive today. I mean, he also
I completely 100% disagree with that. There's names all over the place that are very, very attractive for anybody that has a outlook more than the next 12 months. That's all I would say about that. If you're worried about the next 6 months or so, that's a different argument. But as long as you got a multi-year horizon, I mean, there's steal deals all over the stock market now at this point in time.
The picture of which the market is not exactly cheap.
No, the market is not cheap, but Schlumberger is cheap. John Deere is...
Once again, mid caps, small caps are incredibly cheap right now. The cheapest you're going to find them pretty much in the past 20 plus years. 100% disagree based upon data, based upon facts. Look at the forward Ps of those stocks and what they're trading at. It's the lowest you're going to pay, in literally decades. So, I don't know what he's talking about there. Maybe if you look at Apple stock, but I mean, no.
Cheap. Bank of America is almost at 1 times a book. That's cheap. Starbucks, I mean, I loved what they had to say. They're at trough earnings. The numbers are going higher. I mean, that's rare. Dollar General is cheap. So there's a lot of names out there that I can find. Do they get cheaper? They probably do. But I think for the long term, they're gaining market share. They've got strong free cash flow, and they have excellent executives, and they're proven winners. And so I'm just picking names, not so much the overall broader market, because I think, again, as rates go higher, and I'm in that camp, then I think it's going to be a choppy environment at best for equities.
So yeah, I appreciate her perspective there. And like I said, there's deals all over the stock market right now. If you can't find deals right now, I don't know what market you could find deals in. So, but with that being said, it doesn't mean, you can't pick up stocks for cheaper in a month from now, a week from now, 2 weeks from now, 2 months from now. That's just when you're in one of the, a crashing market, a very rough market. It's just, you never know when the end's going to be. But yeah, there's a lot of steal deals all over this market right now. The amount of stocks I know of that are trading at all-time lows right now, 52-week lows or multi-year lows, it's all over the stock market right now. That won't stay like that forever, but that is the moment in time we're in 2022. And that will likely keep up until the end of the year, or somewhere getting close to the end of the year, roughly. So, yeah, anyways, I hope you guys enjoyed this video. As always, thank you for everybody that subscribed to the channel. We are now approaching 13,000 subscribers. So thanks so much for being here, guys. If you're looking to join my private stock group and get in there, check out the pinned comment down there to apply to join us in the private stock group. Much love as always, and have a great day.